last time I wanted to show you this little chart that we have in the book, and this kind of outlines the accounting cycle for you. That we start off, and we did steps 1 through 3 last time. We start off by analyzing and preparing transaction journal entries. We talked about journal entries, what transactions are, what journal entries look like. If you remember, the journal entry was a list of all the transactions, and each the accounts affected, the amounts. And step 2 was posting. When you post your transaction journal entries to the general ledger. And then step 3, we did that in the last 5 minutes or so, was preparing the unadjusted trial balance. So those are the first 3 steps. Today we're going to do the remaining 7 steps, and don't panic because these are actually not as much as you think. So preparing what we call adjusting journal entries is the first thing that's on our docket for the day. Posting them and preparing something called the adjusted trial balance. The adjusted trial balance is what we use to prepare the financial statements. That's step 7. And then steps 8, 9, and 10 is to prepare closing journal entries, post them to the ledger, and prepare what's called the post-closing trial balance. So it's a lot of different things. But the basic idea here is to record your transactions and get them all into the books, so that eventually your books should reflect everything that happened, all the transactions, and then through your books and through your general ledger, you're going to have the information that you need to prepare your financial statements. So that's just a quick overview of how all this is done. Let's talk a little bit about let's go into specifics now. So activity... When we last left off, remember, we had our unadjusted trial balance. We showed that all the debits equal the credits. The next thing to do is what's called adjusting journal entries. That is step 4. Now, let me explain a little bit about how this works. In practice, students have a lot of trouble understanding why you need to do adjusting journal entries in the first place. Yes?
What activity is this?
What?
What activity?
Activity 87. So, up until now, the transactions we've been recording in steps 1 and 2 are routine transactions. There are things like basically buying and selling. If you do manufacturing, then it's the different steps of manufacturing also. And the things that are done every day on a routine basis. So, for example, you may have a bookkeeper working in your office, and that bookkeeper keeps track of sales. So every time there's a sale, they record, the sales go into the cash register, and they take the cash register information, and they record sales from that. You may have someone else who records cash receipts. They take all of the cash that's received, all of the checks that are received, and they record them and they deposit them in the bank. They record the journal entry for that. You may have someone else who does the payment. So when you pay your bills, they figure out which bills need to be paid, they write the checks, they mail them out, and they also record the journal entries for that. Those are all routine kinds of transactions. But then there are some transactions that are less routine. And these are usually recorded once a month, once a quarter, or once a year, depending on the size of the company. So if it's a large company, they may actually do this once a month. But a very small company may only do it once a year when they're preparing their tax returns. So that's where we get to adjusting journal entries. Another way to think about this is that the typical bookkeepers who are recording regular journal entries are usually kind of they're usually not certified public accountants. They usually, they got an accounting degree from a community college or something like that, and they mainly just record transactions. And when you think of accountants doing boring, kind of repetitive work, very often that's the kind of bookkeeper who you're thinking of. The Bob Cratchit in A Christmas Story is kind of in Christmas Story. That's a Christmas Carol. Different. I'm confusing my Christmas movies. In A Christmas Carol, kind of like that. He's just recording journal entries all day long. And a typical CPA, a certified public accountant, really does something very different. They usually do auditing, or sometimes they do tax work. And that requires a lot more expertise. The students who we typically graduate at Seton Hall, who get their bachelor's, sometimes they also get a master's while they're here, and they go and they take the CPA exam and all this, they're typically handling accounting at this end. And the computation of adjusting journal entries is really a critical, it's probably the most difficult. This and preparing the financial statements themselves are probably the most difficult steps in the accounting cycle. So at the end of the accounting periods, accountants adjust accounts to reflect the correct amounts. Because what happens is if you leave it all to routine, there are some things that need to be done once a period that require a little bit more thought and a little more knowledge about how to do things. And that's what we're going to focus on with step 4. So if you look at the unadjusted trial balance, there are certain balance sheet accounts that need to be adjusted. And let's look back at that right now. One example of it is depreciation. You need to record a depreciation on your equipment. Right? We haven't depreciated yet. Another example is the supplies inventory. If you notice, we had $1,200 in supplies inventory because we bought the supplies, remember? This is all the same example. We bought $1,200 worth of supplies. Well, there's a good chance that we used some of those supplies. So we've got to figure out how much of the supplies did we use. An additional issue is the insurance. We paid for an insurance policy, and we're slowly using that insurance policy up. So what we've got to do now in this step, and when we're doing our adjustments, is figure out how to do these adjustments. So going back here, what I tell you is we've got supply inventory. Prepaid, accumulated depreciation, and prepaid insurance. So those accounts are going to be associated with 3 different income statement accounts. So for example, supply inventory is associated with supply expense. Accumulated depreciation is associated with depreciation expense. And prepaid insurance is associated with insurance expense, none of which have we recorded. But we did do depreciation, right, because we had an asset and we were using it. We did have some insurance because we were covered by the insurance policy, and we also had some supply expense because we would have used some of the supplies. So there are 3 different income statement accounts, these 3 that I just mentioned to you, that need to be adjusted. And they are depreciation expense, insurance expense, and supply expense. There's a rent expense in there. I don't know. Oh, we paid the rent, right? I believe we paid rent. Yeah, there we go, $1,500. We paid it for the period. So these are called the adjusting journal entries. And let's go through them one by one. The first one to talk about is depreciation. Doogie purchased a grooming table and other equipment for $18,000 on July 1st. That's the beginning of the month. This equipment has a 5-year life with no residual value. Straight line depreciation is used. Record depreciation expense for July. Now, how would we record how much? And by the way, the adjusting journal entries, if you look at the old exams, I think we've asked them in the last 2. So this is really important. And this is the question that this calculating depreciation expense is probably one of the questions that students most often get wrong. So let's look at it carefully. How much depreciation expense would there be for July? How would you calculate that?
Find how much in 5 years, right? So 5 times 12.
So it'd be 5 times 12, it'd be 60 months. And so it'd be the cost of the asset divided by the number of periods. In this case, the cost of the asset is $18,000. The number of periods is how many? No. We're only doing 1 month. So 1 month, how many months are there for this asset? 60 months, because it's a 5-year asset. 5 times 12 is 60. So this would be 18,000 divided by 60 months. Everybody gets this wrong. I can put it on the exam, and I know everyone here is going to get it right because I'm alerting you to it now, and you're going to be very careful about it. But you should know that in a regular semester, everybody gets this wrong. 18,000, the price, the total cost, divided by the number of periods. In this case, you're only depreciating for a month. So you divide by the number of months, 60 months. If you were what would 1 year's worth of depreciation be for this asset? It'd be 18,000 divided by 5, 3,600, yeah. But we're only doing 1 month here, so the journal entry would be depreciation expense, 300, credit accumulated depreciation, 300. Now, the amount is one thing which everybody gets wrong. The accounts that you do for a depreciation journal entry are always the same. Debit depreciation expense, credit accumulated depreciation. Debit depreciation expense, credit accumulated depreciation. That was pretty easy. Now let's do one that's a little more interesting. Doogie purchased a 1-year insurance policy for $2,400 in cash. On July 31st, 1 month of insurance coverage has been used up. Record insurance expense for July. How much insurance did the company use up? They used up 1 month of insurance. So how would you calculate the value of 1 month of insurance?
So it's 1 year, so we divide 2400.
So you go 2,400, yeah,
Right?
divided by 12 months equals $200 a month. Now your journal entry, the $2,400 right now is in an asset. It's in supply inventory. I'm sorry, it's in prepaid insurance. That's an asset. So what I need to do here is I need to take $200 out of the supply inventory prepaid insurance, out of the prepaid insurance account and put it into another account. First of all, how do I reduce the account prepaid insurance by $200? Do I debit it or do I credit it? I credit it. Right now it has a debit balance of $2,400. I need to take $200 out, so I'm going to credit prepaid insurance for $200. Credit prepaid insurance for $200, and that has the effect of taking $200 out of the account prepaid insurance. Now, what's the other account that's involved here? Insurance expense. And that's going to be debited for $200. By debiting insurance expense, I'm increasing it. So the asset is going down by 200 and the expense is going up by 200. Let me just, I didn't write these little things here either. Depreciation expense, debiting it is going to be increasing in expense. Accumulated depreciation is a weird kind of account. If I can just tell you, accumulated depreciation is called, I'll write it down here at the bottom. Accumulated depreciation is a contra asset account. It is a negative asset. It has a native credit balance.